Welcome to Views from the North, a Canadian rates and macro podcast. This week, I'm joined by Andrew Wallace, one of our Government of Canada bond traders. This week's episode is titled, Welcome to 2025. I'm Ben Reitzes, and you're listening to Views from the North. Each episode, I will be joined by members of BMO's FIC sales and trading team to bring you perspectives on the Canadian rates market and the macro economy. We strive to keep the show as interactive as possible by responding directly to questions submitted by our listeners and clients. We value your feedback, so please don't hesitate to reach out with any topics you'd like to hear about. I can be found on Bloomberg or via email at benjamin.reitzes@bmo.com. That's benjamin.reitzes@bmo.com. Your input is valued and greatly appreciated. Andrew, Happy New Year. Thank you for coming on the show. It's your first time. I've been trying to wait for a special moment to bring you on, and I guess the first show of 2025 is just that.
Yeah, no, thank you. Thank you for having me, Ben, and Happy New Year to you too, and to all our listeners, which you've built up a pretty good base of, I think. So hope everyone had a good holiday break, and then 2025 is off to a good start.
I mean, I didn't have the best holiday break, but thank you. I'm not a staycation person, and I already knew that, and now I've just learned it again.
Yeah.
But that's okay. I'm going away in Feb, so I'll be much happier then. 2025. So I think we knew it would be kind of an eventful year coming in. You have Trump starting off very shortly. We knew there'd be a Canadian election at some point. Maybe not as soon as it looks like it's going to come, and not with the amount of drama that we've seen thus far. And the market also has been very challenging, let's say, through the first, I don't know, it's January 8th. So.
Kind of a continuation from late 24 too, so yeah.
Exactly. And so it's been interesting so far. What are your highlights going to be for 2025? Like, what are you going to watch most closely? Is it politics? Is it going to be the data? Central bank's going to be the big story. I kind of doubt it, but you never know.
Yep.
Or is it just kind of more just market related, where rates are, issuance, all that kind of stuff?
Yeah, it's interesting. So I guess, looking back at last year, we were talking about this on the desk the other day. It was a really active and busy year in 24. And you kind of forget that central banks only became active halfway through. Yes, you had upcoming elections and some, debates and everything around that, but that hadn't happened yet. And yet there was all this activity and volatility throughout last year. And then you kind of look ahead to what's near term this year, and you just have way more on the plate. You have all this, Trump's inauguration coming up, as you mentioned, Canada's election, and that goes along with the usual issuance, supply dynamics, how that changes with new governments and new fiscal years for the provinces, which come pretty soon as well. So a lot on the plate in terms of what kind of looking at and focused on. From our spot, we try to focus on the stuff we can control and try not to worry too much. Yeah, exactly. So most of the questions we're fielding, especially lately, with what's going on with Trudeau's resignation and everything, is around the political landscape in Canada. The way we look at it, you kind of skew towards thinking, okay, a conservative government's going to take shape in the spring. What's that going to look like? Seems like more fiscal responsibility, less issuance over a period of time. That's longer term, of course. That doesn't change the dynamic over the next couple months. And then, we really have to weigh what the likelihood of some of Trump's threats and talks or what he's saying are going to be on the Canadian market. And we'll get into that a lot, I'm sure, when we start talking about Canada-US spread, which is, outside of the politics, the most topical thing we've been discussing with clients lately. So I think near term, we're focused on the political landscape and how that's affecting things. Tough to really trade necessarily based on that because we just don't know how it's going to play out near term. So from a day-to-day basis, really, issuance becomes very important. We can get into that. We've had kind of a pretty active start to the year in certain facets with issuance. That'll be a big dynamic. Bond auctions, we had a 2-year today, 10-year tomorrow. So I'd say probably our focus is more on that immediate while we're trying to consider, the likelihood of certain outcomes with the politics and how that will affect the curve and spread.
So just to be clear, Andrew's our front end, not quite front end, but out to the belly Government of Canada trader. So that's where his focus is, but he does look at the whole curve. Looking at the market over the past week, and I guess it's really over the past number of months, we've seen a consistent sell-off in treasuries and If you look overseas, the gilt market's just gotten absolutely destroyed. And like I don't know where that ends. Maybe it ends today. Maybe it ends tomorrow. Maybe it ends the next day. I don't really know. But Canada really has not joined in on that, and that's driven Canada to extremely rich cross-market levels. And I guess what in your mind differentiates Canada from everybody else? Like, why haven't we followed the trend we've seen elsewhere? I mean, we have sold off, but just not nearly as much. What's driven that Canada outperformance?
Yeah, so I think there's a few things at play. The major dynamics of late, anyway, being I think the consideration of possible significant tariffs on our economy and what that looks like. So perhaps there's consideration, if there was some consideration that the bank was getting closer to neutral, maybe they're not. Maybe if the impact is significant, rates do need to go lower, in which case, if the Fed's on pause and UK keeps selling off, like really that cross-market spread under that dynamic obviously continues to richen, or at least doesn't cheapen back near term. I think that's a big one. Second one, with the general sell-off in yields, and this is more kind of US and UK related, as you said, we do see better buying in the cash space. Domestic accounts, real money accounts, for a multitude of reasons, with yields kind of around here, 340-ish in longs, they are better buyers around here, even though, you could argue we look rich on a relative basis. For whatever metrics they're looking at, it is attractive around these levels. So we have had some buying where it doesn't seem like other markets are really seeing as much, the U.S. in particular, as that's really driving the spread.
Is it more that they just have so much more supply? Like maybe they also see the same relative amount of buying, but the relative amount of supply is so much bigger that it's just like, well,
I think, and that gets to the next point of kind of what's rich in this, is we just haven't had a lot of issuance, right? We go into December, we get the index extension, we get natural buying from that. The provinces were well ahead in their funding programs. They were pretty quiet. Corporate issuers basically shut it down from early December to January. So there just hasn't been that supply. Now we're getting some supply in GoCs this week with 2s and 10s, but we just don't get a lot of long bond auctions. We don't get a lot of longs in Canada. Another point, maybe under a different government that changes and they turbo some of that. I don't know. But yeah, there just hasn't been a supply, which is another reason I think that Canada has failed to really track the move cheaper, especially further out the curve that we've seen in other markets, is kind of those dynamics, and supply being a big one too, for sure.
We get the 10-year auction on Thursday. It's currently Wednesday afternoon, so tomorrow currently, but when this comes out, the auction will be coming up shortly. 10s have cheapened a lot on the curve. Like 5s, 10s, 30s have cheapened up a ton after having a nice little run for a small period in the fourth quarter.
Fly, I think, closed 18.5-ish today.
Something in that ballpark. I mean, we're close to the top of the range we've seen over the past number of years.
Yep.
The auction size is bigger, so it's up to $6 billion from $5 billion.
Yep.
That's a number that's kind of been consistently rising over the past few years. Do you think that fly continues to cheapen here, or are we gonna keep going, or is this a good opportunity to get into kind of a low beta market long?
Yeah, so that's what it is. I mean, I think the first thing to acknowledge is definitely that it's low beta market long. So if you are of the belief that generally speaking the bond market, global bond markets have sold off a little bit too much, probably looks like a decent trade. I think lagging into it here makes sense. I guess, yeah, supply is a reason why. Really, I think the piece of it that is arguably a little bit cheap near term is the 5s, 10s component. I don't know if 10s, 30s really steepens meaningfully near term. Now, that's partly due to the issuance piece is, we've got some supply this week, not much of it in the long end. You saw Ontario go to the US market with $3 billion US 5 years. That's a lot of supply they're getting in. They're already ahead in their funding programs. Yes, they still have some to do, the provinces, but it's not a significant amount. So if yields stay up around here, I think you get a bit of continued buying of longs, which we discussed. That probably prohibits to an extent a little bit of near-term cheapening of 10s, 30s. But 5s, 10s, I'd argue, is a little bit cheap and has sold off too much. So I think lagging into it here makes sense. I wouldn't be surprised if it's a little bit stubborn and it doesn't quite perform like we've seen in the past where it gets to around this level and it has richened back pretty swiftly. I could see it trading around here. But I think around here, 18.5, 20-ish, I think you start lagging in. I think it's a good trade.
I'm going to challenge you a bit.
Okay.
So 5s, 10s versus 10s, 30s. So I guess 5s, 10s flattening could work in this environment.
Yep.
You think 5s should probably
I think
cheapen up on the
longer
curve?
term, more medium to longer term, I do not like 5s.
Okay.
So we can get into the reasons behind that. I'm sure we will.
We can. Go ahead.
So 5s. Do we want to get into a bit of the backstory of?
Sure.
Yeah.
I mean, we've put it out there a few times, but it's worth mentioning again because it is a potential meaningful market factor for this year. And knowing how things are going to evolve on the housing front, on the deposit front, is really challenging. I think maybe more so now than ever, but it's definitely worth mentioning.
Yeah. So 5s have cheapened a lot. 2s, 5s, 10s fly. 2s, 5s obviously has steepened a lot the last little bit, just with general pressure on yields and steepening in curves. I've talked about it a lot. Most of your listeners and readers would know 5s were extremely rich for a while just from deposit hedging and a lack of mortgage origination in the 5-year space. We looked at some of the charts today, you and I. It seems from some of that and from some of what we're seeing from the bank ALM community that some of the deposit hedging has slowed. As you say, tough to say what that's going to look like over the near to medium term, but it is slow. We're seeing less receiving a 5-year to hedge that 5-year duration, deposit duration. At the same time, we've seen kind of less persistent paying a 2-year and 3-year to hedge shorter term fixings in the mortgage market. So that 2s, 5s structural flattening trade, it hasn't unwound, but it just hasn't been as consistent as we've seen. I think 5s are still, although they've cheapened, they're still relatively rich on that fly, that 2s, 5s, 10 fly. And I think that if you do get some sort of reversal in that, and if you do get a little bit of 5-year fixings, renewals coming up from 2020 in the spring throughout the year, I think that 5s come under a little bit of pressure on the curve on a relative basis. That's why I don't mind 5s, 10s here, especially if you're a little bit bullish on duration generally after the sell-off. So I'm looking for ways to kind of play short 5s throughout the near to medium term as kind of a structural trade this year, whether it's the 2s, 5s, 10s fly, trying to get shorted on any meaningful richening. And then also when we talk about cross-market, if you do like being short cross-market, Canada, US, I have it on right now in 5-year just because I find the 5s a little bit rich, and I think that's my point to pick.
Okay. I suspect the mortgage side of things is going to play a pretty big role. The mortgage curve right now suggests to me at least people are more likely to take a 3-year than a 5-year.
Yeah.
It's like 20 plus ish cheaper, more or less, to take a 3-year.
And how about a 4-year?
It actually goes up in a 4-year.
Okay.
Banks don't want you to take a 4-year mortgage for a reason I don't entirely understand. So the shape of that curve and just the outright level of rate, like because we've had this sell-off in rates, if anything, there might be upward pressure on mortgage rates in the kind of very near term.
Yep.
I kind of doubt that they'll go up because they didn't really come all the way down with the rally. So I don't think we'll feel the full sell-off either. But either way, the level itself, like the 425, 450-ish in 5-year mortgages, just is not low enough, I think, to really spark a huge rebound in that specific sector.
Here's a question too, and I don't know the answer to it, and maybe you have a better understanding or idea on it, but someone who took out a 5-year fixed mortgage in 2020, how likely are they to change to a 2 or 3-year fix versus them being comfortable with a 5-year fix and just saying, even though my rate is significantly different, I know a 5-year fixed mortgage, I'm going to take that out versus run through the analysis that an initial home buyer probably would more scrutiny.
So there's two ways to think about this. So one, it depends who's selling it to them. If there's a salesperson attached to this, they are probably, whatever that salesperson pitches is probably the most likely to go.
Yep.
Canadian financial literacy is not amazing. And so if someone can provide a convincing argument to lock in for a while, that might work. But I think historically, it's whatever is the lowest number is the one that people take.
And so I know the answer to that, so that's what I was kind of asking. So people that had 5-year mortgage will come in and look, 3-year fixing looks better.
Correct.
Yeah.
It's like, this is
perfect.
25 basis points cheaper, done. There might be a little bit of fear about higher rates, but I think rates are kind of high as it is at this point. And until it becomes clear.
When you argue now with the bank being well underway in a cutting cycle, the narrative has definitely shifted to where people now think if you were to poll someone who's not in financial markets on the street, where are interest rates going, they probably think now lower.
Yes. So that was going to be my next point, is like until it becomes clear that they're not cutting anymore. When that day comes, then there might be a lot more appetite to move further out the curve because it's like, oh, these might actually be the lows in mortgage rates wherever we are at that time. Could be here, could be lower, could be high, could be higher for all I know. And people might just be a little bit more willing to step further out just because they know that rates are going higher and they don't want to be exposed to any kind of risk. Because Canadians do tend to be risk averse fundamentally, especially on the mortgage front, I think. So that, I mean, we'll see where things go. I'm still cautiously optimistic on housing. We'll get home sales numbers next week, and Toronto we got this week. They look pretty bad. It's down 15% or so, which kind of puts a bit of a dent in my story.
A little bit of a head fake there late last year.
Well, we'll see. Hold on. Vancouver also kind of softish, but the rest of the country looked pretty good. Okay. So I think what's interesting, and the kind of this works with what I've been thinking about, is like the mortgage rules changed on December 15th. And it made it much easier to buy a house in the $1 million to $1.5 million range. And you see a meaningful pickup in some different areas, like Montreal was up 50% year over year or something like that. And though they've been kind of in that range for a while now, but sales didn't pull back the way they did in Toronto or Vancouver. Tells you maybe that mortgage rule change did have an impact, and you'll see potentially continued strength in the coming months. The higher priced areas, again, Toronto, Vancouver, still more challenging. Rents are starting to pull back. The renters are more than aware of the change in population dynamics. And so they're more than happy to wait and not just snap up any place they can for fear of having to pay more 6 months from now. And I've even heard stories of people asking for their landlords to cut their rent, and the landlord said yes, which is like mind-boggling almost. And so like that change in dynamic tells me that Toronto's probably still got some correction to go. Either prices need to go down, or rates need to go down, or rents need to go up. And rents are going down, then everything's got to go down. So it's pretty challenging. And so like that's why the housing picture is as kind of muddled for me as it is. I am still cautiously optimistic, but rates probably need to fall a little bit further, which may not happen, but we'll see.
So I guess general direction of rates in Canada. Then let's get your thoughts.
That was my next.
Okay. So then we can start talking about some front end cross market pricing and that. But what are some of your thoughts on upcoming data? What's going to influence the bank? How you're looking at it versus market pricing? Because I think I have some similar views as you when it comes to some of this, but why don't you let the listeners know?
It's been a few weeks, so we'll find out. After this broader sell-off here, I'm kind of inclined to say we're due for a bit of a rally. Maybe US 10's got to get to 5% first, but I have trouble believing risk markets generally can withstand a material further sell-off in real rates. So I don't think we're that far, but too many people. I've had this conversation with too many people for me to think we're there today. It just kind of feels like it's got to go further and hurt more people before we get there. And so if rates can go a little bit, can pull back a bit from these levels, we probably still underperform the U.S. on any kind of rally. So that's kind of further out the curve. With respect to the bank, still 25 in January. We need it, and the fact that the housing numbers kind of pulled back a bit should put a little bit of cold water on fears that housing is going to be out of control and just take off. So that's, I guess, positive from that perspective. Beyond January, given where the currency is for me, I'll bring tariffs in a second, but absent that, I think they just have to match the Fed. Like if they are more aggressive than the Fed, we're at 144-ish now on the currency. We'll probably be 3 to 5 cents higher if they signal they're willing to continue to go without the Fed. And that I think is problematic from a lot of different perspectives. There is some inflation pass over time. I think on my the model I have that I haven't opened in 3 weeks, but I think it suggests that core inflation will be about 0.3 higher in the back half of the year due to the currency so far. And that probably will move further. I don't think I had the full impact for the fourth quarter in yet. So there's a few ticks there. And if it keeps going, that's just going to push even further. And so it takes time for that to unfold. But the bank definitely knows that. It's a question of how the data unfolds and whether this GST cut or whatever GST holiday has the impact that they hope it will and boost the economy. I mean, I don't think I've spent any more money.
So this is
but
where
I like it.
This is where, I mean, haven't got the evidence yet, and maybe we'll lay out kind of the timeline of where the data looks and when we'll start getting an indication of that. But in talking to kind of friends and family, it seems anyway that it's having a material impact. You talk about people and they are pumped that they can go and save this percentage, and they're going and stocking up on stuff. And what
stuff are they stocking? There's nothing you can stock up on
household
other than
items,
children's clothing.
I mean, I don't shop at the same wine rack as you do at the liquor store. But the one I was shopping at was pretty bare the other day when I went in.
Now, LCBO has nothing.
Exactly.
It is actually ridiculous.
I guess the evidence I've seen on the street is suggestive that people are spending money. Now, I don't do a whole lot of shopping generally, so it being the holiday period, perhaps it's some of that I just don't really remember what it's like around this time of year. But in talking to some friends and family, that it does feel like people are spending money, and some of which is a result of
that's fair. It was the one day I went to the store. It was early, and I think I had my kid at a hockey game, and I had an hour to kill before the game started because he likes to get there early. And so I go to the LCBO and I go look for wine. And I just stare at it and then I leave. Yeah. And I bought one bottle. The lineup was 40 people deep, and there were people with shopping carts filled. And I was just like, I didn't plan for this. It took me too long to pick the one I wanted. Yeah. And then I was like 10 minutes late for the game. Yeah. That was early in the process, but that is consistent with your anecdotes. So clearly it did have some impact.
Yeah. So the spending, and when we'll get like a little bit of a feedback on, what that has looked like, isn't until February.
The earliest, you'll start to get some December numbers, and even then, that's only half a month. Jan's the full month.
So you do have some time. So the bank won't have anything in their pocket with respect to that until at
April
least
meeting.
Yeah,
April meeting is when they'll have those, like Jan. I guess in March though, the March meeting they'll have some, and then April is like full effect, and you'll have full fourth quarter data in their pocket as well, which at that point I guess will dictate if they can keep going after January and how much if they do need to get down to something well below neutral into the low twos. So the currency is still one of my. I mean, people tend not to care as much as I do, but I think from a sentiment perspective, it matters. I think people see the currency where it is, and
I think perhaps for the bank too, they could brush it off before it got to the danger zone level, or the line in the sand, which was always kind of, when you talk to people, 145-ish was maybe where there would be concern. So now that we've approached that, maybe it does start to become more of a focus than it had been during the first part of the cutting cycle.
I will be listening if he talks about the limits for Canada-U.S. policy divergence. If he's a little less sanguine about that and how it's far away, it's still nowhere near the limits. Maybe we're approaching the limits. Yeah. Or approaching the limits. I think something definitely to listen for when he has his press conference at the end of this month. So I mean that's pretty much the view for now. I think still upbeat on the economy a little bit, in just due to the tax holiday, and Ontario is going to be sending out checks very shortly, I believe. Yep. So I'm due for $1,000, which I'm okay
trip back to the LCBO.
We'll see. I don't know. Maybe I'll put it on my kids' RESP. I mean, some of it is due to them. It is per person. So there is some benefit to having children beyond their joyous moments and all the smiles they bring me. So after the first quarter, there's not a lot to be super upbeat on, other than the fact that rates should matter, and Canada's a highly leveraged economy, and so as rates have come down, that should be a positive for spending. It should be a positive for growth generally, and then you have tariffs. Yeah, and that's the one wild card you mentioned. That's probably keeping Canada relatively rich. Cross market. I agree fully. Like, that would keep me from really putting that trade on in full size. I think it's worth kind of doing a little bit here and then just kind of waiting and seeing how that evolves. And same on the currency front. Like, the tariffs are an issue, and they're a potential economic issue. If he puts it on, the bank's going to cut, and they're probably going to cut aggressively. And you could get below 2% in that case. I wouldn't be completely shocked, as at that point the currency, I mean, does it really matter when you're facing that kind of economic shock?
Yep.
They probably just close their eyes and hope that it doesn't get a lot worse, because it's going to get destroyed anyways. So I'm not even sure if it matters all that much what they do, because a lot of the tariff impact will get absorbed through the currency. And so, yeah, lots of cuts. Yeah. Unfortunately, way lower rates, and then housing really takes off, and that'll be really interesting. And then I would hate the 5-year sector. That would be super
and that's where the cross market really picks up, of course. And I mean, under the kind of scenario we're laying out here and near term outlook, it kind of seems as if, and the way it's trading too is, this cross market could be very stubborn. Like, I think so. Everyone, including myself, thought, we got a bit of a gift at the holiday period, a liquid period. Maybe that was a stretch, puts them on. But, if the bank does cut and they haven't really changed their tune and we don't get that incoming data, even if it is stronger for, a couple months, tariff threats aren't going away anytime soon, especially when we don't have a government to negotiate for a period of time. So, yeah, I mean, it kind of lays out for that being perhaps a stubborn trade for the first part of the year, and then maybe it changes as we get into the spring period.
Second quarter, I like it as a second quarter trade, but I don't think you don't want to be involved. I think you have to have a little bit here, given the levels.
And it really performs in a general rate rally.
Yes, and that as well. And there is risk of that. And I think that risk is obviously growing. So as we keep selling off here, we'll see what jobs do on Friday. I think that'll be interesting, the U.S. market reaction to payrolls. If it is a soft number and we don't end up stronger on the day, that would be really telling for me that the market really actually cannot hold a bid, and then we actually do have a rate problem. So that's one thing I'll be watching for. Or if it's a really strong number, and rates sell off and then risk pukes, then that would tell me that we also can't. So both ways I'm looking at it. Or maybe it'll just be orderly and everything will be wonderful.
Hope not. We don't like orderly in our business.
Less fun. Yeah. So your favorite trades, you don't like fives on the curve medium term, cross market, fade Canada kind of over time, clearly. Yeah. Anything else you like before we wrap up?
I know this is more kind of a macro type lens, the podcast, but one of the issues I have in trading the 2 to 5 year sector is kind of the 3-year point is very rich in Canada. Now it has become a lot cheaper on the curve, and that's largely a result of a lot of the heavily Bank of Canada owned bonds rolling down. June 27 is kind of being the last of those. And so the 3-year sector was persistently rich because they funded rich in repo, the Bank of Canada owned a bunch, and it is a popular spot for central banks to add duration in Canada. So all those factors. Now, what you're having now is all the old 5-year bonds that aren't owned by the bank rolling into the 3-year sector. They have cheapened up, but in my opinion, based on what 2s, 5s have done, not nearly enough. So from an RV perspective, I like trading short 3-year and 4-year bonds throughout this year around current levels. I think if you look at the asset swap curve, it's flat to inverted from 2-year to 3-year, and then you have a very nice upward sloping curve from kind of 4-year, 3.5-year to 4-year out to 7s and 8s. I think what you should probably see is that asset swap curve just consistently be more upward sloping from 2s to 5s, and those 3-year and 4-year bonds kind of taking the bulk of that pressure.
Do you focus on the bigger issues? Is that the...
Yeah, bigger issues, higher coupons, smaller floats, and obviously then where they fund in the repo market. So, certain bonds trade pretty consistently well through general collateral. Those bonds probably a little bit trickier to hold shorts in just because it costs you more to. So all those factors, higher coupons, higher sizes, and then obviously paying attention to where they fund in the repo market. But generally speaking, from I think kind of the SEP 27s, 02, the SEP 28s, as those start rolling down too, I think kind of those bonds have some cheapening to do. SEP 27s and March 28s currently.
Okay. Andrew, thanks. Good first show.
Thank you. Yeah, I'm looking forward to this year. We'll have to do it again after the Leafs win the Cup in the spring, and then we'll have to talk about
then there'll be a massive GDP boost.
Exactly, all the spending. And
I hope I can have you and your mustache on again soon.
Anytime, Ben. I appreciate it.
Thanks for listening to Views from the North, a Canadian rates and macro podcast. I hope you'll join me again for another episode.
The views expressed here are those of the participants and not those of BMO Capital Markets, its affiliates, or subsidiaries. For full legal disclosure, visit bmocm.com/macrohorizons/legal.